Conditions right now at the moment are very robust, as they have been really since we got back on our feet in the middle of last year. And ever since the markets reopened over here on the leveraged finance side in May, June of last year, we've been on a pretty straight trajectory to better conditions. We've definitely seen, we've gotten to levels now where we're at sort of historically tight yield levels, and asset levels have risen in price to a point where it feels like we're at basically a plateau and we should move sideways from here. But overall, the backdrop is incredibly strong at the moment.
How vulnerable would you say high yield markets are to a taper tantrum style reaction if we do see more of a signal from the Federal Reserve and even other central banks that move higher in rates is going to come sooner rather than later?
Yeah, it sort of ties back into the conversation that you were just having about sort of both inflation and defaults. First of all, we expect a very low default backdrop here, sort of in the 1% range for the next year or so, which will be a good buffer there against any kind of rise in rates. So the fundamentals of most of our leveraged credit businesses are still very strong against the current backdrop. Also, I think instructive to see how the market digested the move in treasuries and also the lesser move in bonds in the last in 2021. So if you look at the 10-year treasury, we came into the year just below 1%, sort of 90 basis points there. And when we did see that flare in Q1 into Q2, when 10-year treasury rates spiked up into the 170s, the market was definitely rattled but it really seemed to last 1 or 2 weeks. And then as the Fed stepped in and said the right things, we've now seen that 10-year back down below 150. And the market has really seemingly moved on from that, although is keeping a weather eye on where the treasuries will go, in particular, since there seems to be more inflationary pressure in the U.S. right now than there is in Europe. I think it's less, frankly, as we look at our own market here, sort of more parochially in Europe, it's less of a concern, frankly, at the moment here, because if you look at similar movement in the 10-year bund over that period, we've gone from a minus 60 level at the start of the year to where we're just under minus 20 basis points. So it's only been a 40 basis point move, and the market has absorbed that fairly well. So we can't get complacent about it, and we're all keeping an eye on inflationary pressures upward and what that might do to rates. But for now, it seems to be well digested by the market.